What does it mean when central banks across the world start changing the very composition of their reserves without announcing a new monetary order? The shift underway is subtle but profound. It is not about replacing the dollar overnight, but about building a safety net against an increasingly uncertain global economy. Since 2020, central banks have been increasing their holdings of gold, diversifying into regional currencies, and exploring digital settlement systems at a pace not seen since the 1970s. This video explains what is really happening and why it matters. Modern reserve structures emerged after the Second World War, when Bretton Woods established the foundation of a dollar-centered order. The dollar became the anchor for global finance because it was backed by deep capital markets, political stability, and a commitment to convertibility. The turning point came in 1971, when the United States ended the dollar's link to gold. Even without convertibility, the dollar remained dominant because no other country could match the depth of American financial markets. But periods of stress have always triggered diversification interests. During the 1990s Asian financial crisis, central banks began accumulating larger reserves. After the global crisis in 2008, confidence in financial systems weakened, leading to higher gold purchases. Two trends intensified this shift in the 2020 decade: geopolitical fragmentation and rising financial sanctions. When a major economy such as Russia loses access to its reserves, other central banks take notice. Reserve managers began quietly studying how to reduce exposure to any single currency or jurisdiction. This historical trajectory sets the stage for what we are seeing today. Not a rebellion against the dollar, but a structural recalibration. The acceleration began in 2022. Following sanctions on Russia's reserves, many central banks reassessed the vulnerability of assets held in foreign jurisdictions. This evaluation triggered several quiet but measurable changes. First, official data from the World Gold Council shows that central banks have been purchasing gold at the fastest rate since such records began. These purchases exceed 1,000 tons in several recent years, driven by countries in Asia, the Middle East, and emerging economies. Second, several central banks increased settlement in regional currencies for trade. China expanded use of the yuan in Asian supply chains, while India and the United Arab Emirates introduced bilateral settlement mechanisms for commodities and energy. Although these systems remain limited, they reveal a pattern of experimentation. Third, digital currency pilots accelerated. More than 100 central banks are now exploring digital settlement systems, not because they seek to replace commercial banks, but because these systems reduce reliance on cross-border intermediaries. These developments represent a quiet turning point in reserve management. The objective is resilience, not revolution. The restructuring of global reserves is being shaped by three overlapping forces: geopolitical risk, financial fragmentation, and technological transformation. Geopolitical risk. Reserve assets are meant to be apolitical, but geopolitical tensions have blurred that boundary. Sanctions, export controls, and financial restrictions have elevated the perceived risk of holding too much of any single currency. Countries with strategic vulnerabilities, particularly in Asia, Africa, and the Middle East, now see reserve diversification as a form of insurance. Financial fragmentation. The global financial system is now more fractured than at any time since the Cold War. The dollar remains dominant because no other currency has the same liquidity or stability. Yet the share of reserves held in dollars has gradually declined from the beginning of the 2000 decade, according to the International Monetary Fund. This is not evidence of collapse, it is evidence of structural diversification. Reserve managers are redistributing risk across gold, regional currencies, and diversified asset portfolios. Technological transformation. Digital settlement systems represent one of the most underestimated shifts. Central bank digital currencies are not designed to challenge the dollar, but to create alternative rails for settlement. The Bank for International Settlements reports that cross-border digital currency trials from Asia to the Middle East have demonstrated faster and cheaper settlement. Together, these forces suggest that the global reserve system is entering a multipolar phase. The dollar remains the central pillar, but the architecture around it is evolving. As reserve strategies shift, three medium-term outcomes can be considered. Baseline scenario: gradual multipolarity. Under this scenario, the dollar remains the primary reserve currency. However, gold purchases continue, digital settlement systems expand, and regional currencies gain incremental roles in trade. Central banks operate with diversified portfolios rather than relying overwhelmingly on one asset type. Strategic realignment scenario: regionalization of reserves. This outcome becomes more plausible if geopolitical fragmentation continues. Asia could expand use of yuan-based settlement corridors, while Gulf economies deepen currency linkages through energy trade. These systems would not replace the dollar, but create parallel lanes for regional commerce. Stability stress scenario: financial shocks drive faster diversification. If global debt pressures rise or major economies face prolonged fiscal strain, central banks may accelerate their shift toward gold and alternative assets. Periods of financial volatility historically strengthen diversification behavior. In such a world, reserve managers would prioritize liquidity and security above yield. Each scenario reflects different weightings of the same underlying pressures: uncertainty, fragmentation, and strategic caution. Diversification offers protection, but it introduces structural risks of its own. Liquidity constraints. Alternative assets such as gold or regional currencies do not have the same liquidity depth as dollar assets. In a crisis, liquidity matters more than diversification. Coordination gaps. As more countries adopt different settlement systems, interoperability becomes a challenge. Fragmented systems may increase transaction frictions rather than reduce them. Market volatility. Gold is a store of value, but it is not immune to price swings. Heavy reliance on gold can expose reserves to commodity cycles. Institutional readiness. Digital settlement systems require technical capacity and regulatory coordination. Not all countries can deploy these systems effectively, creating uneven adoption. The risk is not that the dollar loses its role. The risk is that the emerging system becomes uneven, creating pockets of instability. As central banks quietly rewire their reserves, the world is moving toward a more complex monetary landscape. The question is simple but profound. Are we witnessing the early stages of a resilient multipolar system, or a fragmented reserve structure that could amplify future shocks? If strategy, history, economics, and finance shape the world, this is where they converge. Subscribe now and join the conversation.